Well, this is the Chapter 1, 2, 3 exam review that you can follow along in your student notebook. And we're only going to cover the questions that relate to Chapter 3. Chapter 1 and 2 you can review in some other way, but Chapter 3 is what we're going to focus on in this review. So the actual exam is going to be 30 multiple choice questions, 150 points, practice exam, unlimited attempts, real exam, 1 attempt. And like I said, only Chapter 3 will be what we'll cover on this review. So the first question that relates to Chapter 3 is number 7. On June the 30th of the current calendar year, Apricot Company paid $8,700 cash for management services to be performed over a 2-year period. Apricot follows a policy of recording all prepaid expenses to asset accounts at the time of cash payment. The adjusting entry on December 31st would include what? Okay, here's our accounting equation. Here's the accounts that we're going to be using. And the first thing we're going to do is we're going to pay the $8,700 cash out. So cash goes down under assets. And what goes up would be a prepaid expense, which is an asset also, called prepaid management fees. And that's when we first make the payment on June the 30th. Now this is for 2 years, and we're trying to figure out the adjusting entry on December 31st. So how much time has gone by from June 30th to December 31st, and how much of this asset will be used up at that point. So 24 months divided into 8,700 means that each month we're going to use up of this asset $362.50, and there are, looks like 6 months have gone by from June 30th to December 30th. That'd be July, August, September, October, November, December times, which is 6 times 362.50, and that means of this 8,700 we're going to use up, or we're going to expense, $21.75. So the entry, the adjusting entry, will be to credit the asset, lower it, $21.75, and to also show an increase in expenses called management fees expense for $21.75. This is a typical prepaid adjusting entry where we're going to lower the asset and increase the expense. Let's see, and here's a journal entry. You can do it in journal form: a debit to management fees expense, $21.75, and a credit to management fees, prepaid management fees, $21.75. Next question is number 8. We says that prior to recording adjusting entries, the office supplies, which is an asset account, had a $341 debit balance. A physical count of supplies showed $123 of unused supplies available. They required adjusting entries to do what? Okay, here's our accounting equation. Here's what we have to begin with. We have a debit balance of $341, but we only actually have $123 worth of supplies. And we always want our asset account to agree with what we physically have, which is $123. So the difference between these two, 341 and 123, is how much we're going to make our adjustment for. So if we currently have 341 and we want this account to be 123, then we're going to have to adjust it down by the difference, which is $218. So we will credit this asset account to lower it to $218, and we will debit office supplies expense for $218. And the journal entry would be a debit to office supplies expense, $218, and a credit to office supplies for $218. This is another typical prepaid item that is now being used up over time, and we're lowering the asset value and increasing the expense. Now keep in mind, both sides are going down because assets are going down $218, owner's equity is going down $218, and the even though supplies expense here is going up, you know, anytime an expense goes up, it lowers owner's equity. So our next question, number 9. On April the 1st, a company paid the $2,160 premium on a 3-year insurance policy with benefits beginning on that date. What will be the insurance expense on the annual income statement for the year ended December 31st? And we're supposed to round the answer to the first to one decimal place. Here's our accounting equation. Here's what's happened. On April the 1st of the current year, we spent $2,160 on insurance. It's a 3-year policy, so we credit cash to lowers this cash asset, and we increase prepaid insurance by $2,160. That's what happened on April the 1st. What we want to know is how much of this is going to be an expense on our income statement at the end of the year. So we have 36 months divided into 2160, and so each month this prepaid insurance is going to go down, or should be used up, by $60. So the number of months involved between right now, April the 1st, and December 31st, there'll be 9 months have gone by, which would be April through December, at $60 a month, or $540 will be used up. So we will lower the prepaid insurance account by $540, and we will increase insurance expense by $540. There is in a journal form, and this is the same as we had the last time, which is a prepaid expense item being used up over time, and we're lowering the asset and increasing the expense. But keep in mind, both sides are going down. Assets are going down, owner's equity is going down. And let's see here. There's the 540. And now let's go to the next question, which is number 10. On January the 1st, a company purchased a 5-year insurance policy for $1,925 with the coverage starting immediately. If the purchase was recorded in the prepaid insurance account and the company records adjustments only at year end, the adjusting entry at the end of the first year would be what? Okay, here's our accounting equation. Here's our cash account. We spent $1,925 in cash on a 5-year insurance policy, which is going to be a prepaid asset. So we credit cash and we debit prepaid insurance. And now the question is, how much have we used up for this first year? Well, it's a 60-month policy. We divide that 60 into 1925, and we have $32.08 per month being used up out of this policy, just like our last situation. So it looks like to the nearest dollar, we will have 12 months at $32.08, or $385 to the nearest dollar that we have used up of this asset, which will go into an expense, and we'll credit prepaid insurance for $385, and we'll debit insurance expense for $385, and here it is in a journal form as opposed to a T account, and that's number 10. Number 11, PPW Company leased a portion of its store to another store for 8 months beginning October the 1st at a monthly rate of $975. This other company paid the entire $7,800 cash on October the 1st to PPW Company, and PPW Company recorded this as an unearned revenue when they first got the money. So the journal entry made by PPW Company at year end on December 31st would include a what? Alright, so we'll take this from the very beginning. This is the accounting equation of PPW, and they received from this other company $7,800 for rent for a store situation. So we're going to take in cash of $7,800, and since on October the 1st none of it has been earned yet, we will debit cash and we will credit unearned revenue for $7,800. Now the question is, how much of this unearned revenue or liability should be counted as a revenue for the 3 months October, November, and December? And remember, this $7,800 payment was for 8 months. So we will take $975 per month, which is the amount of rent per month, times 3 months, October, November, December, and of this $7,800 we have earned as of 12/31, December 31st, we've earned $2,925. So we're going to remove $2,925 from the liability as a debit, and we're going to credit rent earned revenue for $2,925. Here it is in a journal form. We're reducing the liability and increasing rent earned. Noticed that both sides have stayed the same with this entry. For example, liabilities have gone down, so this has gone down by $2,925. This account has gone up $2,925, or overall for this entry, this side has stayed the same, which is the same thing that happened over here. This side has not changed. The asset side hasn't changed. Next, number 12, an adjusting entry was made on year end, December 31st, to accrue salary expense of $2,700. Which of the following entries would be prepared to record the $6,000 payment of salaries in January of the following year? Well, this is a part of a multiple choice question. What I'm going to do is just show you how it should be done without a multiple choice set of answers. So here's what's going on. Here's our accounting equation. We're at the end of the year, and we have accrued salaries of $2,700. That is, we owe people money for work they've done in this current year that ends December 31st, but we're not going to pay them until sometime, actually usually it's the first paycheck in the new year. So to properly record that and to properly get this expense on the books, this accrued expense on the books as of 12/31, we're going to do the following. Here's salaries payable, salary expense. We're going to, on December 31st, make the following entry. We're going to debit salary expense for $2,700, and we're going to credit salaries payable for $2,700. This properly records the liability that we have for the salaries, even though we're not going to pay them until sometime in the new year. It probably also records the expense. Now, the very first payroll in January was for $6,000. So what are we going to do with this $6,000, and how does it relate to the entry we made at December 31st? Well, the $6,000 covers two things. It covers last year, that's this $6,000 payment made in January. It covers the last year's salaries that we owed, plus what's left will be this year's salary expense, this current year. So we will take the $6,000 and we will credit cash for $6,000. The first thing we'll do, since we know this $6,000 is for salaries we owed last year, part of it is, we will reduce this liability to zero by debiting this for $2,700, and the difference between the total cash of $6,000 that we paid out in January, first payroll check, and this $2,700 for last year will be this year's salary expense of the difference of $3,300. Here it is in a journal form. We debit salary expense for $2,700. We credit salaries payable. That was done as of the end of last year, 12/31. Now the new entry in the new year for the first payroll check in January will be debit salaries payable $2,700, debit salary expense $3,300, and credit cash for $6,000. And this is the entry that we're going to make in the new year. That's the accrued entry we made at the end of last year. Number 13. Company purchased a new truck at a cost of $38,500 on July the 1st. Companies don't buy things usually for full 12-month periods. They buy them whenever they need them. In this case, it happened to be July 1st. The truck is estimated to have a useful life of 5 years, a salvage value of $3,500, which means that's what the truck will be worth at the end of its useful life in 5 years. The company uses the straight line method depreciation. How much depreciation expense will be recorded for the truck during the first year ended December 31st? Okay, here's our accounting equation. Let's go from the very beginning of what happened until we get what the adjusting entry is going to be. So we bought a truck, cost $38,500. So we're going to credit cash for $38,500 and debit truck for $38,500. that means this asset goes down, this asset goes up, and so far everything's okay. Now that was on July the 1st. Now we got to record depreciation, and we're supposed to, for the answer for this question, we want to know how much depreciation expense will be recorded on the truck for the first year. Well, the first year is only a half year because it starts on July 1st and goes 12/31. So we're going to make a calculation. 38.5, the cost of the truck, minus the salvage value. That what's left is called the depreciable amount. We'll divide that by 5 years, and since this is a half a year, we'll take half of that, which will be $3,500. And instead of crediting for this depreciation entry, crediting truck, we're going to set up a new account called called accumulated depreciation truck for $3,500. We can never, because of the cost principle, we can never record a depreciation entry directly into the truck because it looks like someone is someone sold part of the truck, but that's not what happened. The truck is just going down in value. So when you want a value for this truck, you need to always consider these two accounts together. That is the truck minus the accumulated depreciation, and that will give you what the value of the truck is. All right, well, so anyway, first year depreciation, which is the answer, will be $3,500, and that's the entry. But I'm going to go a little further just to show you some more things involved in this. So in the second year, the depreciation expense is going to be $7,000, and we'll debit depreciation expense for $7,000 and credit accumulated depreciation for $7,000 because that's a full year. Over here, the calculation was for a half a year. So for one full year, we'll have $7,000. The next full year, we'll have another $7,000. The next full year, another $7,000. And let's see, that's 4 years. Next full year, we'll have $7,000. And now we've got, let's see, 4 full years, one half a year. And now, let's see, we've got to record the final $3,500 for the last part of the 5th year. And notice the total amount of depreciation we're taking here is not 38.5, but 38.5 minus 3,500. So that's what I wanted to show you here as we go through this. Okay, number 14. A company recorded 2 years of accrued salaries, 2 days, I'm sorry, for accrued salaries of $3,400 for its employees on January 31st. Now what that means is they worked sometime in the last 2 days of January. We owe them $3,400, but we're not going to pay them until the next paycheck, which comes out on February the 9th. And on that paycheck, the total paycheck was for $11,000. So how do we show, first of all, the January 31st accrual entry and then the payment of salaries on February the 9th for not only the February salaries, but what we owed them as of the end of January? This is similar to a problem we did a few minutes ago. So here we go. Here's our accounting equation. Here's what happened on January the 31st for the 2 days that we owe these employees, but we're not going to pay them. We're going to debit salary expense, and we're going to credit salaries payable for $3,400 as of January 31st. Next, we're going to, on February the 9th, write out the payroll, and we're going to credit cash for $11,000. And of that $11,000, $3,400 of it takes care of the accrued salaries that we owe these employees as of January 31st. So we'll debit salaries payable $3,400, and the difference between $11,000 and $3,400 will be what the current February salaries are, which will be $7,600. So here it is. Part 1, set up the accrual as of January 31st, a debit to salary expense, credit salaries payable. Part 2 is to show that we are going to, on February 9th, do 2 things. We're going to get rid of the payable, that is, we no longer owe these people the accrued salaries for January 31st, and we are going to pay that off. And the second part of this is we're going to also give them the money we owe them for as of February 9th, or in the month of February. So part 2 is the debit salaries payable, 3,400, debit salary expense, which is the February salaries. These are the January salaries here in 3,400, and the total will be how much we'll pay out in cash, which would be $11,000. Number 15. On May the 1st, year 1, Carter Advertising Company received $46.80 from Caitlin Brianna for advertising services to be completed April 30th of the following year. So keep this in mind. This is May 1st of year 1, April 30th the following year. So there's one whole year going on here, but it looks like it's split between year 1 and year 2. The cash receipt was recorded as an unearned fee, which we'll do in just a minute. That is, this $46.80 was all put into unearned fees when we first got the money, because we haven't earned it. Assume no entry was made for unearned fees during year 2. The adjusting entry for the end of year, for the year end, December 31st, year 2 would include what? This is a very tricky problem because of the way it's worded right here. What they want to know is the adjusting entry for year ended December 31st, year 2. So let's start from the very beginning and record this thing. Okay, here's our accounting equation. Here's the account we're going to use. And the first thing we do is we received this money from Caitlin Brianna, $46.80, which will debit cash. This is the books of the Carter Advertising Company. So we're taking the money in. We're going to also show a liability that's unearned revenue of $46.80, and that's when we first get the money on May the 1st. Now, let's see what's happening on from May the 1st, year 1, to December 31st of year 1. Because most companies only make adjusting entries for financial statement purposes at the end of each year. So $46.80 was the total amount we received. This is for a 1-year, looks like, advertising services. So every month that goes by, we are earning of this unearned revenue. We're earning $390 a month. So how much did we earn from May the 1st to the end of the first year? How many months have gone by? Well, it looks like 8 months have gone by, and we've earned a total of 8 times $390, or $31.20. So at the end of the first year, now that's not what, we're not answering this question yet, but at the end of the first year, we have earned of this $46.80, $31.20. So let's show that, because it's normal to show that at the end of each year. So we will reduce this liability with $31.20, and we will show earned revenue of $31.20. Now that's what happened. That's the adjusting entry for the end of year 1. The question doesn't want that. The question wants, what's the adjusting entry at the end of year 2? Well, the end of year 2, notice that we're going to do the following here. In year 2, we've only got 1, 2, 3, 4, January through April, 4 months of this advertising that we have yet to earn. It will all be earned in the first 4 months of year 2, but it says up here, assume no entry was made for unearned fees during the year 2. So we have to wait all the way till the end of the year 2 to make this adjusting entry, which we will make at 12/31 year 2. We could have made it at the end of April of year 2, but no, it says not to do that. So if we're not going to do that, then we'll do the following. We'll make the entry at the end of the year 2, and the entry will be a debit to this liability account, $1,560, and a credit to earned fees. And that will take care of earning all the other 4 months that are left on this advertising contract. And that's the end of the problem. So you could make the following adjusting entry: debit unearned fees $1,560, and credit to earned fee revenues $1,560. And this is the adjusting entry they want. That's the question they want to have answered, is this right here. Number 16. The balance in the prepaid insurance account before adjustment at the end of the year was $5,900, which represents the insurance payments or premiums for 4 months. The premiums were paid on November the 1st. The adjusting entry required on December 31st is what? Okay, here's our accounting equation. What we know is that we have a balance in this account, prepaid insurance asset account, of $5,900, which represents insurance premiums for 4 months. Okay, well, that means that would be 4 divided into 5,900, or $1,475 per month. That's how much this account goes down each month. The premiums were paid on November the 1st, so really these 4 months would cover all of November, December, January, and February. So the adjusting entry required on December 31st is to show 2 months of these 4 months worth of premiums being used up or expensed. So 2 months have gone by from November the 1st to December 31st. That's $2,950. We'll credit this asset account $2,950 and debit insurance expense for $2,950. Here it is in a journal form. Insurance expense is debited $2,950. Credit insurance, prepaid insurance $2,950, and that takes care of this one. And now number 17. On March 31st, Phoenix Company paid Melanie Publishing Company $16,920 for a 3-year subscription for 5 different magazines. The subscriptions started immediately. What is the amount of revenue that should be recorded by Melanie Publishing for each year of the subscription, assuming Melanie uses calendar year reporting? So Melanie, this is the books of Melanie. On Melanie's books, we're going to do the following. We're going to first of all take in the cash of $16,920, and we got this money on March 31st. And as soon as we took it in, none of it had been earned. It's not earned until we start giving the magazines to this customer. So we'll debit cash for $16,920. We will credit unearned revenue, which is a liability account, for $16,920. And now, let's see, this is for 3 years. So 3 years would be $16,920 divided by 36 months. Or every month we're going to earn $470 worth of this revenue. So from March 31st until the end of the year, which it says it reports on a calendar year basis, how many months have gone by? Well, it looks like 9 months have gone by, which would be April through December. That's 9 months, and that's $470 a month. And so of this $16,920, this Melanie Publishing is going to earn $4,230 of the money. So let's show that as a year-end adjusting entry, which will debit $4,230, that's liability, reduce it, and show earned $4,230. And then here's the next year, second year, because they want to know what is the amount of revenue that should be earned, recorded by Melanie for each year of the subscription, assuming we use a calendar year reporting. Well, in year 2, we're going to earn all 12 months times 470, which is $5,640, and we'll show that up in the T accounts. Year 3, we're going to earn another 12 months, which is $5,640. So we'll reduce this liability by $5,640 and show revenue of $5,640. Year 4, we're going to only earn 3 months, January, February, and March, which times 430, which would be $1,410. And let's see, notice it was a full 3 years, 3-year subscription. So $1,410 will be taken out of here, which makes this account now 0. This side and this side are now exactly the same. And we'll show the revenue for year 4, $1,410, 3 months. Number 18. On December 31st, excuse me, on December the 1st, Miller Company borrowed $570,000 at 6% annual interest from the Nomo Bank. Miller has 120 days before the first payment is required. What is the adjusting entry that Miller would need to make on December 31st, the calendar year end, using a 360 days in a year, which is usually called a business year? So here we are on December 31st. And let's show the accounting equation here. We borrowed $570,000, so $570,000 cash goes up, and we'll put that under notes payable also, 570, and that was on December 1st rather. It's a 120-day note, and we want to show how much interest should we accrue on this note from December 1st to December 31st at 6% annual interest. And so let's make the calculation. So 30 days worth of interest, which is what this is, would be 570 times 0.06, and that's going to be times 30 over 360, which is interest to the nearest dollar of 28.50. And then to make the adjusting entry for that, we're going to need a couple more accounts. Interest expense of 28.50 and interest payable of 28.50. And this is the adjusting entry that we're going to make to show what is the adjusting entry for Miller to make on December 31st for the interest. And that's the interest entry. And so we can show it in journal form, interest expense 28.50, a debit, and a credit to interest payable for 28.50, and that'll be a credit.